Hello, everyone. Welcome to a new series that we are starting today, Chai Pace Talks. And this is a series where Kalpak and I from Tequity Investing, we will be discussing stocks over a cup of chai. And before we get into the details of the series and we start this presentation for the day, I want to give a small disclaimer that this particular series is not an investment recommendation in any particular way. It is just an infotainment and it is for investor information. Or if I simply put it, it is a conversation over a cup of chai. So, Kalpak, how is your cup of tea today? Mine is
Wow,
smoking hot.
actually, cheers, Abhinit. My cup of tea smells good. It even tastes great, and I'm really excited to do chai pe talks with you. So, speaking of smell and taste, let us today discuss a company which is engaged in the fragrances and flavors business, or what is called as F&F. Name of the company is SH Kelkar and Company. So the company is mainly engaged in the manufacturing of fragrances and to a smaller extent in flavors and allied research in these areas.
That's right, Kalpak. And today we are going to discuss about S H Kelkar and Company. And it is almost a century-old company, to be precise, around 90 years old. And it's a business run by the third generation of the promoters. So Mr. Kedar Vaze is the group CEO of the company presently. And the business is into various segments like personal care, skincare, and cosmetics. Okay. And they have also expanded into something called as flavors. Okay. So there are primarily two variants of the business. One is fragrances, and second is flavors. The fragrances business is more about catering to the personal care segment, detergents and soaps, and nowadays during COVID time, catering to the hand wash and the sanitizer segment.
Right.
So, yep.
So Abhinit, actually since listing in November 2015 on the Indian stock markets on NSE and BSE, the company listed at a share price of 180 rupees a share. And since the listing in mid to 2017, the company's share price doubled and peaked at about 350 rupees a share levels. But since then, it has been a downward trend in the stock price of the company. And it has, as you can see on the chart, the company has, not been doing very well since 2017 when it peaked. Currently, it's about 85 rupees a share as on this recording. The market cap of the company is 1,200 crores approximately.
Yep.
And in the last financial year, they clocked a revenue of 1,114 crores consolidated revenue. Right. So, Abhinit, I have a question for you. A company that's almost a century old, okay, a market cap of 1,200 crores, it's not very large for that older company.
Right.
And the growth is also relatively small, about 9.5% CAGR over the last 10 years. Okay. So all these into consideration, do you think it is behaving like a mature company with no further room for growth?
That's a great question, Kalpak. And the first thing that comes to any investor's mind after looking at this kind of a company is, it's a thousand or odd crore market cap today. And like we said, the company is 90 years old. So the first thing that will come to your mind is probably the company has been very conservative. Okay. But that doesn't seem to be the case with the third generation. Mr. Kedar Vaze has announced some ambitious plans for expansion of the company. Okay. And the company has been on an acquisition spree. We will talk about the acquisitions that the company has made in a while now. Okay. The very important point that I want to highlight is SH Kelkar imports most of its raw materials. Okay, and when it comes to making fragrances, okay, there is a whole bunch of raw material the company needs. Okay. Now the point that I want to highlight here is the company has a proprietary process of making their ingredients. Okay, sorry, not the ingredients but the end products. Okay, so what is so proprietary about this particular process? The thing is, when you're making fragrances, you have to mix it in a particular proportion, and that process is developed over a period of 90 years. Okay. Now, when we are saying this, it is a big moat for a company in itself. Okay. And if you see the clients, the current client base of the company, a few reputed names that will be related to is Synthol, which is a Godrej product. Okay. Then the company has a whole bunch of other customers like Marico, Dabur, Imami. Okay, Godrej is something that I already mentioned. Okay, and if we look at the overall, if you look at the overall stickiness of the customer, it is quite high, Kalpak, because nobody would want their products to smell different each time you buy it. Okay, just imagine you buy your favorite soap each time and it smells different. How will you feel? Okay, So that in itself is going to act as a moat for the company. And we have seen that overall the stickiness of the customers is quite high in this business.
Okay. So Abhinit, that was a very cute looking drawing that that you just showed there.
Yeah. So, my nephew has drawn this for us.
Okay, that's very nice. So raw materials are mixed in some sequence and final fragrance is prepared. And I think what you mean, I get what you mean. Uh, I would not like to have a different smelling soap every time I use a synthol soap or whatever it is.
Absolutely.
And I think throughout the life cycle of the product, that stickiness is a big advantage for this company. We look at a little bit on the revenues by segment. So almost 94% of the revenues of the company come from the fragrances business. And
Right.
also you can see that the fragrances market is quite well diverse. About 32% comes from exports and 68% comes from domestic market. Not
Right.
just that, one would worry that what do these guys have some client concentration? Even that is not the case. 40% of their sales comes from big ticket clients, what they call. 30% comes from mid-sized clients, and then 30%, which is they classify as 10 lakhs or lesser per year, they come from smaller client bases, and they have a total client base of more than 3,000 customers. Okay, so
Okay, that's a big number. Yeah.
it's a very beautiful revenue mix for the fragrances market. Now, flavors market is only 5 to 10% of their revenues. Last 2 3 years, it has been growing tepidly, considering how small that business is. So let us focus on that. For this presentation, we'll mainly talk about the fragrances business. But it has a strong moat. It has a wide customer base. It has a sticky customer base. These three things work in the company's favor, in my opinion. Abhinit.
Oh, wow, that's great. And if you look at the overall structure of the market, so if we talk about the nature of the market, whether it is structured or unstructured, so you would be slightly surprised to know that 75% of this particular market is structured. Okay, it means it's an organized market, and SH Kelkar holds a decent amount of market share in this. It's a 21% market share in the fragrances business. So to have a 21% market share in the in a structured or an organized market, it means something. It's a significant achievement according to me. Okay,
Right.
Talking about the main competitors of the business, main competitors of the company. So we have Geodon, we have Firminish, we have IFF, and there is an Indian company called as Oriental Aromatics. Okay. So the first three that I have mentioned here, those are the foreign MNCs, and the last one that we have, Oriental Aromatics, is an Indian MNC. Okay, and as far as the flavors business is concerned, the company has around 2% market share in the flavors business. Okay, and like you rightly mentioned, as a proportion of their total revenues, 90% comes from fragrances and only 10% from flavors. Okay, there's another point that I want to highlight, Kalpak, is despite the company having an edge in terms of customer stickiness, they do not seem to have an edge when it comes to raw material pricing. And the reason precisely for that is the company imports most of its raw material, and owing to the very inherent nature of raw materials, the prices are volatile, and the company is not always in a position to pass on the raw material cost, right? Because the company has long-term contracts with customers, and it is not feasible for the company to every time pass on the raw material cost. Okay, so we are talking about a business which has customer stickiness, but it doesn't have a lot of pricing power.
Okay.
Yeah.
Right. So I think that is a very interesting point, Abhinit. Also, another point I would like to add here. Okay, in my understanding of the research I did for this company. Okay. Firstly, like you rightly said, sourcing raw materials is a problem. Pricing power is a problem. Another problem is that this is a relatively slowly growing market. Okay. Internationally, it is growing in single digits. That was lower single digits, and even in the domestic markets, it's not very rapidly growing. So the best growth rate would be what an FMCG client of its grows. It will have a similar growth rate, okay? And the company already has a decent market share, okay? And as we know, business is sticky. So getting market share from somebody else is not very easy or straightforward. But that being said, new customer trends, lot of new products in the market. 10 years back, we had only 5 or 10 soap or detergent products that we could buy. Now you have a host of products. So that is a promising thing for the company. Okay, but at the end of the day, the reality is that on a larger scale, it is a slowly growing market. That being said, Abhinit, let us quickly take a look at this slide here, which is kind of a snapshot of its last 10 years performance of, you can say, the income statement. You can see that the sales have consistently grown. I marked that in the green, and I had a CAGR of 9.3%, which is quite impressive. Okay, and what I find good is it has been a consistent growth. It has been growing. Okay, what I don't like, Abhinit, okay, is if you look at the operating margin row, okay, the operating margins are on their way down. And I can tell you, Abhinit, for the last 10 years, the company has increased its capex. Capex is just plant machinery, okay, to manufacture their products. From about 150 crores, they've increased it 4 times to 600.
Oh, wow. Okay.
That is a big thing for a legacy company to do. Okay.
Right.
New capex means, added fixed cost. Okay. But it has also increased revenues. But if you can see, it has caused a strain in the operating margins. Okay.
Absolutely. Yes.
So it's too early to say because this capex will play out over a longer duration. But if you can see in red, they are about 13-14% right now. What used to be 18 to 19%. So that is the area of concern for me. And Abhinit, this capex that we spoke about, okay, the company, they have funded it through both debt and equity. Okay, as you know, the company listed in November 2015, and they have taken a lot of debt. While there have been no issues in repayment of debt, they have been timely. What I find very worrying is the net profit number on the lowest row. If you can see, it has barely moved. Okay,
absolutely.
So we are having incremental sales at the cost of profitability. I mean, that has been the snapshot I can give of the last 10 years. Okay.
Right.
However, going forward, this capex might play out. They have a lot of underutilized capacity. Okay. And might achieve scales. Okay. And improve their operating margin and subsequently pay off their interest costs and pay off their debt, which will have a positive impact on the net profits. That's my take on this.
Abhinit, very true.
Yeah, a more detailed analysis of this.
Sure. So now what I'm going to jump to is I'm going to jump to the 10-year numbers. And if you look, we have already given a breakup of the 10-year numbers. But on a very higher level, if you see, the company has made more, cash from operations when compared to the profits. Okay. Now, very briefly, what does this mean is it means that the company is in a position to convert its profits into cash. Okay. It is not doing business on credit. Okay. It doesn't give a lot of credit to its customers. Okay. But the problem starts here. If you see, the money invested in fixed assets is 527 crores and the money invested in acquisitions is around 103 crores. Okay. So what it means is the company has been pumping back all the money that it has generated from operations, and it is on an expansion spree, which I mentioned a couple of minutes back. Okay. Now, if I talk about the number of subsidiaries that the company today has, they have a whopping 16 subsidiaries. Now, you can imagine 16 subsidiaries for a company worth 1,200 crores. Okay, so this is the first cause of this is the first cause I would say a red flag for me because I'm not really sure how much required these subsidiaries have. Okay. Now, there are some regulatory requirements because the company does business in multiple countries like Netherlands, Singapore, China, Indonesia. Okay, and they have their subsidiaries there. Okay, and of course they have a couple of subsidiaries in India. But it really needs a closer look as far as the number of subsidiaries are concerned. Okay, because there's a scope for merging these subsidiaries, and we really don't know when something like that is coming up. So that's a point of contention for me.
In fact, Abhinit, as we speak, they're finishing a acquisition of an Italian company, and they're trying to venture into what they call as fine fragrances, which is kind of an upmarket product. And they're saying that it is a higher margin product, which will help their bottom lines in the future. Also, the CEO, to their credit, right? From our analysis, one thing is clear that the working capital side of things is quite well managed. The subsidiaries is a cause of concern. The acquisition spree is probably even, I don't really like that. And I don't really know how well the capex has been utilized. Okay. And, history is not on their side. Okay. Let's put it simply, but it is not impossible to turn it around. So we will not discount that from them. Okay. A positive during the coronavirus is also that in the Q1 FY21, despite almost 45, half the quarter being a washout, no business activity at all, they were still able to post decent revenues, and they also had a green bottom line, which is a very good thing. And there is, like you rightly said earlier, there is a new demand that has come because of COVID and related products like hand sanitizers, hand wash, okay, which that definitely is a new area. But one thing that I like that the CEO, Mr. Kedar Waze, mentioned is that now that they are at the end of their capex cycle, they have a lot of excess capacity and they have a lot of room to grow without making new capex. Okay, so one thing that is very critical to watch, Abhinit, is how this plays out in the next 2-3 years. Do they actually first meet growth? Secondly, are they able to? Are they? Did they stop making new acquisitions? Are they using the capex well? Thirdly, if they're able to continue to service their debt costs and reduce the debt they have on their books, and finally, can we see bigger bottom lines and bigger, hopefully, dividends or capital gains for customers? That remains to be seen for this business, I believe.
Right. So things that matter the most. Bottom line.
That's right.
Right. So I think Kalpak, our chai is getting cold, and we need to kind of wind this conversation up. So these are the subsidiaries that I just mentioned. 16 subsidiaries. Okay. So if I have to summarize, Kalpak, so it's a good company. It's an established business in a very niche area. Okay, having customer stickiness, and the kind of customers that they service is a fast moving. These are the fast moving companies. Now, of course, if HUL is growing at a 10-12% per year, then a company like SH Kelkar will grow, right? Okay. And of course, now let me quickly touch upon valuation. So I have done very I would say raw kind of valuation, not a very detailed one, and the company appears to be in the value zone. All right. And if you look at what doesn't work in the company's favors, of course, the cash flows. All right. All the money that has been made from operations has been pumped back into the investing activities. Okay. So they have been on an acquisition spree. Subsidiaries haven't performed as expected. Now, this is one thing which I want to tell you is the company has decided to wind up operations of one of its subsidiaries in Netherlands. Okay. Now, something like this, it happens, and the company, it immediately loses investor confidence because the company has been aggressive in acquisitions in an industry which is relatively slow growing. Okay. So again, that's what I wanted to say is subsidiaries haven't performed as expected. And management is getting aggressive in a company that appears to be in a stable growth industry. So if I have to give a final verdict on it, it is definitely a good business. Okay, I've given the ratings there. So business, I have rated it 5 on 5 because it's a niche. It has a moat. Okay, valuations look good. But definitely when it comes to execution, and when it comes to execution by promoters after an aggressive acquisition spree, it needs a wait and watch. So I wouldn't subscribe to the thought of, investing in this company at this point in time, and especially not in a manner where I put a lump sum chunk in this particular company.
Right, Abhinit. So I think we can conclude this chai drinking session. I'm almost out of my chai. So
well, I'm almost out of my chai. The only thing is I cannot prove that I'm out of my chai.
So guys, what did you think of this stock? Do you own this stock? Is there something else you would like us to cover? If you have some stocks you would like us to cover, please mention them in the comment section below. Please subscribe to our channel. We intend to put one new video every week, at least to start with this. And hope you enjoyed this cup of tea. Thank you.
Thank you, everyone. Thank you.